Hi, my name is Kurt Nilsen with True Compass Lending, and I help people get financing for their homes. Thanks for joining me here today. As a mortgage consultant, part of my job is to help advise people on ways to improve their credit. I put this short credit score workshop together to give you some valuable information on a subject that's often misunderstood. My goal is to help clarify some things around credit scoring so you can make your score the best that it can be. Credit scores are an important part of our financial life these days, and our credit reports are often analyzed when applying for a job, and they're definitely analyzed when looking to secure insurance or a home mortgage of any kind. So it goes without saying that this is a very important topic. I'm going to cover a lot of information at a pretty quick clip. I'll show you some do's and some don'ts that'll help maximize your credit score. So what does a credit score mean? And I get this question a lot. Credit scores are based on thousands of other credit reports, and it predicts the statistical chance of a consumer becoming 90 days late on a particular loan obligation over a 24-month period of time. The credit score is generated by analyzing the information contained in the consumer's credit report at that point in time. So it's essentially a snapshot in time, meaning that snapshot can change for better or for worse from month to month, depending on how well we manage our credit. The last statistic I saw showed that the median credit report score is about 720. So half the scores in this country are higher and half are lower than 720. As you can imagine, a credit score says a lot about the way creditors look at our ability to repay debt, which can, of course, affect the rates that we pay on loans or insurances of all kinds. Statistically, a person with a 620 or lower credit score has a 1 in 15 chance of going 90 days late. A person with a 620 to 679 score has a 1 in 47 chance of going 90 days late. A person with a 680 to 719 score has a 1 in 112 chance. A 720 to 719 score shows us that they have a 1 in 649 chance, and 800 score or above a 1 in 1485 chance of going late on a payment. Going to kind of get into the meat of things here, and this stuff is really important. I'm going to show you a percentage of how your credit scores are calculated. Past delinquencies, or also known as late payments, account for 35% of how your credit score is calculated. Now, this is the largest piece of the pie. And just to be clear, when I say a late payment, I don't mean 10 or 15 days late. It's when it goes 30 days late when problems happen to your credit score. And even this is kind of something that a lot of people don't know. Even a $15 a month payment that's paid 30 days late can wreak absolute havoc on your credit scores. The older the delinquency, the less effect it has on your score. We found that a recent 30-day late can affect your score as much as 30 to 60 points or more. And if you have a 60-day late, it'll probably be more like 50 to 100 points. So because past delinquencies or late payments is the largest portion of how your credit score is calculated, it makes sense that this is the most important aspect of your credit score to pay attention to, and that's paying your bills on time. Here's another huge part of your credit, and it's the second largest factor in determining your score. Revolving debt ratios account for how 30% of your score is calculated. This ratio is sometimes called your utilization ratio, which is basically the ratio of your high credit limit versus your high balances. As an example, let's say you have a credit card and they approved you for a $1,000 high credit limit. If you want to highly maximize your scores, don't ever charge more than 30% of the high balance offered. So if they offer you a $1,000 high credit limit, keep your balance at 30% or $300. If you need to improve your scores, pay your balances down to below 30% on the revolving accounts that you currently have. The average age of your credit file accounts for 15% of your credit score. Another question I get a lot is, should I close an old revolving account or an account that has no balance? Please be aware that if you close an account with no or low balance, it's going to affect your utilization ratio that we just spoke about. So be real careful. If you don't have very many revolving accounts and you start closing them, your scores could go down. Your mix of credit affects about 10% of your score, and we know that if you have one or two installment or car loans such as that, 2 to 4 revolving accounts like credit cards, preferably with low balances, and 1 to 2 mortgages, this seems to be a real good mix of a credit balance. Last but not least, inquiries count as 10% of your score. Some things that you need to know here: when you pull your own credit, it does not affect your score. If you're shopping for a car or a mortgage, inquiries count as one credit pull for the next 45 days. So a real quick overview of the credit scoring components, and honestly, if you get nothing else from this workshop, please remember that past delinquencies or late payments and your debt ratio account for 65% of how your score is calculated. So paying your bills on time and keeping your balances at 30% or below of the high credit limit offered is crucial to your good scores. So now I'm going to cover the very best credit scoring tips that I know of. Revolving, also known as credit card accounts, are more important to your score regarding the balance to high credit ratios. What I mean by that is focus on keeping the revolving accounts balances at the 30% or less ratio. Revolving accounts are given greater weight than the secured installment loans, and they carry significant weight with the credit bureaus as they demonstrate responsibility and behavior when given free rein to this kind of credit. Hence the importance of not charging more than 30% of what they offer you. And I know I'm repeating that a lot, but it's very, very important, and I can't emphasize that enough. Installment accounts such as car and home loans are not as important to pay down the balances on, so really don't worry about paying car loans or home loans down. Use any money that you have to pay down revolving accounts to that 30% or below ratio. Mortgage lates will severely hurt your credit, so make sure that those are never 30 days late. And just kind of as a side note, adding a child as an authorized user to one of your revolving accounts can help their credit when they're just getting started. Basically, this can kind of help them piggyback off your good credit history. So it's a good idea to add a child as an authorized user to one of your accounts. But be very, very careful about ever being a co-signer or a joint borrower, as your credit will be affected if the other party is late or defaults on that payment. If they ever default, the company's going to come back on you, so exercise caution there. Now, this is a huge one that there's a lot of misunderstanding around, and basically paying off collections or charge-offs will not increase your credit score. So do not pay these off no matter what a bill collector says. The bottom line is, once an account has gone into collection or charge-off status, it's already done the maximum amount of damage that it can do to your credit, and only time is going to heal that credit wound. Now, I know it seems kind of illogical in that you would think that paying off something would help your credit, but in reality, what it does is it registers as renewed activity on a negative account. So it's best, obviously, not to let them go into collections in the first place, but if they do, leave them alone and don't pay them off, because if you do, your scores are going to drop. One of the best ways to boost your scores, if you don't already have 2 to 4 revolving accounts, is to get a new credit card, either secured or unsecured, from your local bank or credit union. Now, I'm not suggesting that you go into debt unnecessarily, but having a few of these revolving accounts that you charge to, again, less than 30% of the high balance offered, and then make the minimum payments required each month is going to do a lot to help your credit. If you have poor credit or have some recent problems, you may need to get what's known as a secured card, which means that you have to deposit a little bit of money with the bank that's issuing you issuing you the card. Use it lightly, keep the balances low, make the payments and repeat. Keep a low balance on the card at all times. Make each payment on time, every month, and this is going to definitely activate your credit file and help you build your scores very, very quickly. Don't close any old credit cards. This is going to help your debt utilization ratio. And remember that the debt ratio accounts for 30% of how your score is calculated. So don't worry about closing those older cards out. Also remember that the older the account is, the better it is, which gives you more history, which, as you recall, the history is 15% of how your score is calculated. What's really, really important is that you establish new positive credit, either using secured or unsecured credit cards after a bankruptcy or a series of negative events, collections, etc. Lenders want to see, kind of a new and improved track record of you being responsible with your credit after a negative event. Bad things happen to good people sometimes, but based on this information that I'm giving you, we can fix all that. Don't apply for a bunch of new cards to try to drive your scores up. This is going to increase the number of inquiries to your credit, and if you recall, inquiries account for 10% of how your credit score is calculated. As far as a proper mix of credit accounts is concerned, and don't get too hung up on this, but in general, 2 to 4 revolving accounts are okay. 1 or 2 auto loans are okay. If you start getting into 3 or more auto loans, it does start to hit your scores a little bit. 1 mortgage, or a first mortgage and a second mortgage, are okay. If you have 3 or more, that starts to hit your scores a bit. And try to keep your credit inquiries at 3 to 5 per year. So I know you've seen there's a lot of commercials out there touting free credit reports and blah, blah, blah. The only one, frankly, that we endorse, and the only website that's monitored by the Federal Trade Commission where you will not be charged for a copy of your credit report, is annualcreditreport.com. Not freecreditreport.com or all those other things that you see. It's annualcreditreport.com. So go there. You can get a copy of your credit report, as you're entitled by law to get a free copy of your credit report every 12 months. So we're just about ready to finish up here, but the other thing I would suggest is go to the website optoutprescreen.com, and this is the official consumer credit reporting industry website to accept and process requests to either opt in or opt out of offers of credit or insurance. So go to optoutprescreen.com. By going in there and opting out of offers, this is usually going to cut down on your junk mail, and it's going to stop them from reselling any of your information, and in some cases it can actually help raise your credit scores as well. So that's it. You just got my very best advice on how to optimize your credit. I want to be a resource for you, so if you have any questions regarding home loans, getting approved for your home loan, credit questions, or anything at all, I'm just a phone call or an email away. There's never any cost or obligation for my advice. I adhere to a golden rule in my mortgage business, and that is that the advice and information that you get from me is the exact same that I would give my parents or my best friends. So thanks a lot for tuning in. I trust it was time well spent for you. Have a great day.